Hi, everybody. Welcome to our deeper dive into Compound. We are going to give folks a few minutes to join, and then we will kick it off. Seeing some great engagement. Good morning, everybody. Panelist number is, I think we'll give it one more minute and then I'll kick things off for us here. Okay, let's kick this off. Good morning, everybody. Thank you for joining. I am fortunate enough to be joined today by Compound founder and CEO, Rob Leshner. I also am thrilled to introduce to you all, Grayscale investors and the general investment community, our new head of research, David Greider, who has joined Grayscale. He's going to be creating content, thought leadership. So I'm really pleased to have him on the team and to have him on with me today. So the purpose of these, for those of you who haven't been on before, the purpose of these deep dive webinars is to really make tangible the protocols underlying the products that we have. And I think we get on with the founders. And that's the idea, is to just make it something that folks feel like they can touch and feel. No question is too silly. And of course, none of this is investment advice. You should always consult your own broker or advisor, and our private placements, including our Grayscale DeFi fund, are only available to accredited investors. So now that I've done my disclaimers and intro, I want to kick it off to Rob. Rob, do you want to provide us some background on, yourself and how Compound came to be created in the first place? Like, what problem were you looking to solve?
Absolutely, and just want to say, I'm excited to join this session and webinar with you all this morning. So Compound was founded in 2017. And at the time, this was an era in crypto when there was a lot of activity on exchanges where people were buying, selling and trading crypto for dollars and for other crypto assets. And there was not yet a concept of decentralized finance or DeFi. In 2017, there was a blockchain called Ethereum that was starting to gain prominence, where developers were writing smart contracts and deploying them on the blockchain. These are, simply computer programs, but these computer programs can open source, transparently and autonomously manage assets, create logic, and add a whole layer of programmability to assets that you haven't seen before. And so in 2017, we decided that we were going to use this new technology, smart contracts, to create an autonomous market for interest rates on crypto assets, so that any type of user would be able to earn an interest rate on the crypto that they have, or borrow crypto that they would like, and pay an interest rate. And we created Compound using smart contracts. And today, this is known as decentralized finance, or DeFi. And it was one of the first applications to attempt this structure to administer a market. And it has created a playbook that a lot of other teams are using when they seek to create DeFi applications as well. At the time, there was some semblance of interest rates being offered through like the margin trading books on centralized exchanges, or through over-the-counter lending. But This was attempting to create a market that barely existed at the time and has since begun to scale. So today there's about $20 billion of assets earning an interest rate in compound and being borrowed. The market in 2017 was essentially zero. It took years to start to create these markets that today are relatively commonplace.
So how does, how does it work? How does compound work? Explain it to me like I am a 5-year-old who doesn't know anything.
Yeah, absolutely. So compound, the protocol is a series of markets. So every asset that's on the Ethereum blockchain, for the most part, all the large assets, there's a market for. And this market is, the starting off point is an interest rate that you can pay to borrow the asset. So if you want to borrow a stable coin like US dollar coin in order to, cash out the fiat or buy more assets with, or trade for any good, you can borrow US dollar coin from the protocol. If you want to borrow Ether to purchase NFTs or to run smart contracts on the Ethereum blockchain, you can borrow Ether. If you want to borrow a token to use in some other application, you can borrow that asset. So Compound lets people borrow assets, and when they do so, they pay an interest rate, and that interest rate is paid to all of the other users who want to supply that asset to the protocol. So there's borrowers and there's suppliers who are providing the liquidity for people to borrow. And when somebody borrows, it's not based on credit worthiness or their identity or who they are or their character. It's based on the collateral that they provide to the protocol. So in this way, the protocol is able to measure the risk of a borrower very discreetly by analyzing the collateral that they've posted to the protocol and the value of that collateral in real time. And it enforces that a borrower always has more assets posted than what they're borrowing. And so a great example is you might borrow $1,000 of US dollar coin by posting $2,000 of Ether as collateral, or you might borrow Ether using Bitcoin as collateral. It allows you to really borrow any asset you would like using any other asset or portfolio of assets as collateral. And in this way, it's a system that when a user is supplying assets, they don't have to discern the creditworthiness of the borrower. They just have to understand that the protocol works based on collateral and that all of the accounts are auditable and monitorable in real time. And so, anyone can inspect the health of the market and see that, every user is solvent. They can see, how the protocol functions, and they can see that when people are borrowing assets, they're incentivized to repay them later because there's more collateral in the protocol than what they have outstanding.
So it's completely transparent, auditable, peer-to-peer lending that is collateralized the way I might put up my home to get a loan from a bank, for instance, except people are putting up cryptocurrencies.
Yeah, that's exactly right. And, this is the biggest advantage of a DeFi application versus a financial product or market run by a business using spreadsheets and people and all sorts of contracts and processes. The entire system is running as a smart contract. And so every aspect of it and every parameter of it is transparent. And so, you can, it's just like you borrowing against your house, you're borrowing against, other crypto as collateral. And, the system in its entirety is essentially open source. So anyone can build applications that monitor Compound or analyze the markets or analyze the solvency of individual users.
Hey, Rob, thanks a lot for joining first off. And that's a great overview on what kind of Compound is doing and the problems it's solving. Maybe just give folks a little bit of background and understanding on the comp token, and maybe for kind of people who are maybe more familiar with Bitcoin and Ethereum, a little bit how maybe it functions relative to some of those tokens, maybe how those fit in the protocol, and also maybe some of the other tokens that kind of are in the network.
Yeah, absolutely. So the comp governance token is a tool to add predictability to the protocol. So the protocol is upgradable over time. You can add new markets to the protocol. So if a new crypto asset comes out, you can add to Compound. So if there's a market for it, to be able to borrow it or earn an interest rate on it. The functionality of the protocol is evolving and living as well. And there needs to be a system in place by which the protocol can be modified, but in a way that adds reliability and predictability for its user, because you don't want something to change overnight. You don't want one person or one team to have the power to change something. So the comp token is the tool by which the rules of the protocol evolve. So comp is a governance token. It's one of the first examples of what's now called a governance token. And what it does is it allows the users to vote on changes to the protocol. So if there's a code upgrade that's going to add new functionality, all of the token holders through a 7-day process are able to vote on whether or not this code change is desirable or not. This could include, analyzing what it does, how it changes the protocol, and ensure that it's, a positive and safe upgrade. And so comp is being used to vote on changes, whether it's changing the interest rate parameters of a market or adding a new asset or, modifying the functionality of the protocol in some way.
Yeah, I think that's really exciting. You're really giving kind of the community a voice in how kind of the protocol develops. Are there any kind of recent, updates that maybe have come from that or are coming on the horizon? Obviously, you can't disclose anything that's, non-public, but maybe give us kind of some of the recent history and stuff your folks are looking out for.
Yeah, so this is actually a really exciting question because at this point, development of Compound is what I would call open source and open to the community. So in a lot of ways now, many of the upgrades to the protocol are actually coming not from Compound Labs, which originally built Compound, but from developers in the community who are writing modifications to Compound and then having the token holders approve those changes or new markets or new activity. And so, I can speak for Compound Labs, but the community, there's always unexpected things that people are building that are really exciting. At Compound Labs, we recently announced a product called Compound Treasury. This is an interest account built on top of the protocol. The really exciting thing about the Compound protocol is that anybody can build a business on top of it. Anybody can build an application on top of it. Anybody can source the interest rates or the liquidity for their own use cases. And so Compound Labs recently introduced a product called Compound Treasury, which is a dollar-based product. And what it does is it accepts dollars from customers, converts them into stable coins, supplies them to the Compound protocol, and offers a yield. This product is beginning to drive, significant new customer types and usage patterns into the protocol. And I think it's a really interesting example of a team, creating an open source protocol and then building a business on top of it that drives usage and volume to the underlying protocol.
Yeah, no, I think that's pretty awesome, Rob. Obviously the thing about these that's most innovative, right, is kind of what you described. Anyone can kind of build on top of this kind of open protocol. Maybe talk us through like a little bit of that innovation and just kind of what you see.
This is actually one of the most interesting attributes of decentralized finance. So Compound is operating as a smart contract or computer program running on a blockchain, and anybody can interact with this. You can interact with this smart contract yourself. So you can have your own wallet, you can custody your own crypto, you can interact directly with the smart contract. But it's not limited just to users. So other smart contracts can interact with Compound as well. So if you're a developer out there, you can build an application that directly interacts with the Compound protocol, that earns an interest rate or borrows liquidity from it. In addition, because this is now open to individual wallets and other smart contracts, you can build an application in any format on top of this. So you could build a business on top of Compound that just interacts with it programmatically or manually. And every set of permutation is possible in this. And so it allows a lot of experimentation and new creative ideas to flourish, where you can combine Compound and another DeFi protocol, or build a business that combines Compound and a fintech system like Stripe. Like, the possibilities and permutations are pretty endless. And in DeFi, this is called composability, and I think it's one of the biggest strengths of decentralized finance.
I want to take a little bit of a step back and come back to just how we can think about the token and drill down a little bit. So you touched on governance tokens. Perhaps some folks aren't as familiar with what a governance token is. So can you just drill down a little bit more into how to think about comp, governance tokens, and how to put them in context with tokens that other people might know in terms of how they work, like Bitcoin or Ethereum?
Yeah, absolutely. So, a governance token is really like very different from Bitcoin or Ethereum. So Bitcoin is a currency, and its value comes from the fact that it's scarce and you can send it to anybody that you would like. It's a very simple cryptographic asset. Ether is a more complicated asset in that it's powering this smart contract blockchain, and that the Ether is used to deploy smart contracts and interact with smart contracts. One of those smart contracts is Compound. And Ether in a lot of ways is useful for interacting with a DeFi application, and its value really is derived from how many people want to interact with these smart contracts. The third class of tokens, which is very different from the first two being a currency or fuel, so to speak, is an application or governance token. So Compound is an application that's built on top of Ethereum, and the governance token owns the protocol. So the protocol can only be modified by the comp governance token holders, and the governance token holders essentially have ownership and modification rights of the protocol. And so in a lot of ways you can think of this as similar to corporate governance, that you would use to manage a legal entity. In the crypto world, you have a token that provides token governance of a cryptographic protocol and market. So in this case, the comp governance token is what controls and decides on changes to the Compound protocol. And so it's a very different type of asset. I think that those who are interested in the underlying protocol and its growth and its metrics are able to analyze it in the context of a governance token in a way that you wouldn't look at something like Bitcoin.
So with the token, So2 transfers the rights to make decisions around the protocol and affect outcomes in the protocol. And if I'm a token holder and I care and I want to cast a vote, great. If not, then presumably I sell my token to someone else who wants to cast a vote, and that's the way. That's kind of how we think about value and the transfer of these assets, and who's really providing the outcome of this protocol. Yes
and no. I mean, I think some of that is completely correct, but a lot of people don't vote their Amazon shares. They don't say, oh well, I'm not going to vote them.
Right.
They're worthless. I'll transfer them to somebody else. They say, oh well, I just know that other people are going to be using these and voting and participating in corporate governance. Whereas I think a lot of investors are passive and don't participate directly in the governance process.
Okay, that makes sense.
So maybe one way for kind of framing value, or just the token for folks, is like, maybe I have a bunch of BAT, for example, and I really just want that to be listed and I want increased liquidity. I mean, that's, it's useful for me to own comp for that reason, right? Because maybe I can get it on there and I can kind of help facilitate borrowing lending on your guys' platform. Is that maybe one or a couple of the ways that could be really like incentives for folks?
Yeah, I mean, the primary incentive is that, the governance token controls changes to the protocol. So whether it's adding new assets or changing the way that the protocol functions or how it's deployed, that's really where the token comes in.
So what is, obviously this is really exciting. What's your big focus today? And what's your, what are you excited about today? What's your vision going forward? What would you like to see, 3, 5, 10 years from now?
Yeah, there's a lot to be excited about. So, I take a very long-term focus. And I think that in 10 years, what you're going to see is that more assets are crypto assets living on blockchains than aren't, right? I think in 10 years, pretty much every asset's going to be issued on a blockchain, as opposed to through like very legacy systems of records. I think most of the assets on stock exchanges are one day going to be issued, on blockchains instead of like through paper and spreadsheets, so to speak. And so I think in 10 years, the number of assets that are accessible to a system like Compound is going to grow exponentially. You know, when we started Compound in 2017, we said, oh, it's going to take 10 years, 20 years before there's a lot of assets that a market like Compound can support. And I think that, you know, it's a waiting game. But I think in 10 years, you know, you're going to be able to, you know, borrow treasuries on Compound or use treasuries as collateral to borrow, you know, dollars. I just think it's going to be a process of waiting for assets to live on blockchains. I think the other thing that's happening very quickly is that the user experience of interacting with a protocol like Compound is getting easier and easier. In a lot of ways, I think it's analogous to the internet in like 92, where anyone could have run their own email server. There was a couple email clients, but very few people used email. It took AOL and Gmail to make it easy enough that people didn't have to interact with an SMTP server themselves. They could just, you know, get the benefit of the system. I think we're going to see over the next couple of years the user experience of Compound improving dramatically. You're not going to have to custody your own crypto and interact with a smart contract on your own. You're going to be able to get the interest rates from Compound or the liquidity from Compound through an exchange or a custodian or a broker or a bank. And so I think, you know, the biggest thing to look forward to is that, you know, Compound is going to, you know, continue to exist as like a layer or a protocol, but you're not going to be interacting with it directly as a user. It's going to be more integrated with a larger and broader financial ecosystem.
So this
Yeah.
is, go ahead, David, jump in.
Oh, no, I was just gonna say, yeah, I mean, I definitely see it how we're kind of moving to a world where you guys are really kind of, you know, protocols like yours are really in the back end, and you have businesses like Coinbase, right? Kind of just as the user interface, right? To kind of make it tangible for folks, you know, custodying some of the assets or some of the other solutions. Maybe, you know, walk us through maybe a demo, Rob, of kind of, you know, share your screen a little bit and give us some, a little more context on maybe how the protocol works so folks can get a little more tangible with it.
Sure. Yeah, happy to. So, okay, so I'm going to right now just share a market overview of the Compound protocol just to give you a sense of what's happening in the protocol. So right now there's $19.7 billion of assets earning interest in Compound, and there's $8.8 billion of assets being borrowed from Compound. You can see the most popular assets that are being supplied and being borrowed. Stable coins dominate the assets being borrowed. This should not be a surprise. People love to borrow dollars. It's the primary use case of the protocol at this point. And borrowing USDC, DAI, and USDT, which are three different stablecoins, dominates the borrowing activity. You can see the composition of individual markets, and you can see for any specific asset, like US dollar coin, you know, a history of the interest rates and the metrics of the market. And you can see details of the market, including the interest rate model. So one of the things I didn't touch on before, but I think is very important to something like Compound, is that the interest rates aren't set by somebody, you know, every day deciding what the interest rate should be. They're actually set by the market according to an interest rate model that takes into account supply and demand to borrow the asset. And in this way, the interest rates adjust in real time as market conditions change. So you can see the interest rate model that, you know, US dollar coin adheres to, where you can see the borrowing cost and the supply interest rate. And you can see the different metrics of the market. You can see how many users there are, how many borrowers there are actively, and how much liquidity is available in the market. So right now, you know, if you were an institution, you could borrow $1.2 billion of USD coin from the protocol right now. And this gives you an overview of, you know, the different markets available. So you can find this at compound.finance/markets. If you want to see what the Compound protocol looks like as a user, you can see that when you log into, you know, Compound, you're basically bringing your own cryptographic wallet. So this address has supplied $3.48 of sushi token. I'm earning an extremely small interest rate on this because there's very few borrowers for the sushi token. You can see all of the different markets. You can see the interest rates available, and you can see, you know, what you're able to do with each of these assets. When you go to vote on different proposals, there's no active proposals right now, but there's a tab to vote on any active governance proposals, and you can see how many votes you have in your wallet. I think to give you a quick overview of governance, there's on compound.finance/governance a history of and we'll wait for this to load for 2 seconds, there's a history of all of the participants in governance and all of the protocol proposals that have ever occurred, whether they've been executed or they failed, or what the history is. And you can see every change that's ever been made to the protocol since governance was launched and how the protocol has been modified. And this is a 7-day governance process that uses the comp token. So if there's a proposal to adjust the collateral factors of different assets, you can see, how many comp tokens voted for the proposal, how many voted against the proposal, the history of the proposal, and information on what the proposal does. So in this case, some assets had their utility as collateral to borrow modified. And this is a great example of what a governance proposal looks like. It changes some parameters. It might not be, changing the functionality of the protocol or the way things work, but it changes parameters. And so, oftentimes these are linked to, a forum post that goes into like the history of the different proposals and debates and discussions, et cetera. So this is really, the governance architecture of the protocol and where comp comes in. And you can see all the proposals here. And, there's also how many participants there are. There's currently 1,727 addresses participating in governance, and there's 2.8 million comp that are participating in governance right now. Lastly, I think what's really interesting to show off is that Compound is an open protocol. We touched on this composability before, but there's actually, a robust amount of documentation for developers on how to integrate the Compound protocol and how to build applications on top of it. So there's lots of different guides that have been set up, and there's lots of documentation available for developers on how to interact and build the Compound protocol into your own system, whether that's an exchange or a custodian or a new application. So the documentation is really important because this is in some ways a tool for individual users, but also a tool for developers. And this power is really, I think, expressed in the documentation and showing that this is an open product and protocol, not simply, a business. So with that, I'll stop my screen sharing. But if you're interested in the Compound protocol, using it directly to earn an interest rate or borrow or participate in the governance of the protocol, all of this is available on compound.finance.
So this is great, and we actually have a ton of questions, and I apologize in advance. We are not going to be able to get all of them, but I am going to attempt to, ask you some of the more topical ones that have come up from clients and from folks that are listening. So we were just talking about votes. Are governance votes anonymous?
So they're pseudo-anonymous. So the way it works is any address, which is just a cryptographic, public address, can hold comp tokens and participate in governance. Many of the larger voters or participants choose and elect to identify themselves, but it's voluntary. So you could have an anonymous address participating in governance, and you can also voluntarily tag your address and identify your profile, so to speak.
Speak more to how, specifically the algorithm or how the interest rate is determined. I don't know how technical you want to get.
No, this is a great question. Okay, so each market has an interest rate model that defines what the interest rates are at any given amount of supply and demand. And so what the community does is they define the model that the market's going to operate on. And all of the models essentially say, if borrowing demand is high, interest rates are high. And if borrowing demand is low, interest rates are low. And all of the models generally define this, but in detail, they define what the curve looks like and how quickly interest rates rise as a function of demand. These principles play out in every financial market. If you were looking to borrow Tesla stock, if nobody was looking to borrow Tesla stock, the borrowing cost would be very low. If everyone is borrowing it for a governance, action or to short sell it or whatever, the borrowing cost might be extremely high. Compound markets work the same way, where the borrowing cost really is a function of demand. For assets like, tokens that don't have too many active uses, the borrowing demand is very low. For stablecoins, the borrowing demand is typically relatively high. And each market has its own interest rate model that governance sets. And you can, if you're really geeky, you can see the exact code that all of these models operate on. You can see the algebra of them all. You can, play around with them on the markets pages of Compound, but it's really like a little module of the computer code that defines very specifically what the interest rates are and how they work.
So I think, I just have a quick fault. So basically I want to make sure I get this. It's all, you have your supply demand curves and the different models have different levels of elasticity and people vote on basically the level of elasticity of the model.
Exactly.
Okay.
And kind of inherent in that, right, is some of the risks or like interest rate risks, and maybe just walk people through like how, folks know kind of, I put my money in my Ethan Compound, the protocol, or my USDC, and thinking about how the protocol manages some of those risks and keeps the lending process safe.
Yeah, absolutely. So there's two primary risks to Compound, and you can read, and I'll screen share a little bit again, just for 4 seconds. There's two primary risks to Compound. There's technical risk, which is the risk that there's an undiscovered bug in the protocol because this utilizes novel and new technology. And there's market risk, which is the risk that borrowers' collateral isn't sufficient and they lose the incentive to ever repay what they borrowed, or they have a debt but they don't have any assets in the protocol. Those are the two primary risks: technical and market. On compound.finance/docs/security, you can see some of the information that analyzes these risks, both done as security audits of the protocol, as well as formal verification of the protocol, as well as the economic security of the protocol. And this really goes into the two primary risks: technical and market. Now, on the technical side, there's the risk of a bug. Now, every new application, every DeFi protocol has this type of risk, but it's also a function of transparency and the work that's gone into securing the information and the passage of time. Compound has $20 billion in it today. It didn't start off with $20 billion in it. And the security of the protocol increases as a function of time and not having any issues. So there's never been a bug in the code of the protocol that has occurred or has lost users money. It doesn't mean that the likelihood is completely zero, but the likelihood of it, is proven lower and lower and lower every year that elapses without an incident, as long as all new code goes through the same thorough process that the existing code has gone through. So that's the first risk, is technical risk. There's been lots of DeFi applications that have had bugs that have made it to production, either because they weren't audited or because they were rushed or because of other factors. And I usually advise, friends and family and myself and, individuals that you can trust a DeFi application the longer it's been around without incident. But it doesn't prove that Compound is guaranteed to be safe, just that the risks are low. And the second is market risk. And this is the risk that, the collateral that borrowers provide is insufficient if the protocol is saddled with losses. And this is also a risk that is based on the passage of time. When Compound was brand new, to be transparent, we weren't sure if a 30-40% daily sell-off in crypto would be handled by the protocol successfully or not. Since Compound has been running, there have been multiple massive market corrections where crypto is sold off 30-40% in a day, and the protocol hasn't incurred any losses. And this is really a function of those collateral factors and the parameters of the protocol and the market risk parameters being managed by the community in a safe and judicious way. And it's possible that the risk parameters are too conservative or too loose, but that is represented in the market risk. And there's no guarantee that the protocol won't suffer a failure from market risk. It hasn't happened to date, even through multiple massive market corrections, but that's the second risk of the protocol.
So on a micro level, what happens if I, Ray, have put up a bunch of Ethereum to borrow some stable coin and the value of my collateral, just declines dramatically? What happens? Like what are the sequence of events? And then do I post more collateral?
Yeah, absolutely. So you're required to maintain excess collateral when you borrow. So if you want to borrow, $1,000 of USDC using Ether, you might have to maintain a minimum of, $1,300 worth of Ether. If the value of your Ether is going down, you either have to provide more collateral to the protocol or you have to repay what you've borrowed. But if the ratio is ever insufficient, anyone in the community can liquidate your position by repaying what you've borrowed and taking a corresponding amount of your collateral. So the way this works is if, Ether's dropping in value and, your collateral is declining, anyone in the community can say, oh, this is looking a little bit dangerous. We're going to repay the USD coins you borrowed. We're going to repay $100 of it, not even the whole amount. We'll repay $100 and take $108 of Ether. And in this way, it reduces the risk of the borrower and ensures that the protocol stays solid.
And are they incented to do that because maybe they want to sell USDC and they want to buy Ethereum?
Yeah, so, a liquidator is oftentimes looking for just a short-term profit, and they're given like an economic incentive to repay what you've borrowed because they receive a little bit more collateral than what they're repaying. So you're basically seeing the protocol paying somebody to de-risk at-risk users.
Okay, that's great.
Yeah.
So I have another.
Yeah, please go ahead. Next question.
So go ahead, please.
Oh, I was going to say it's a system that's been running for a few years, and any data scientist or analyst can pull like all of the data for every position and every user and every liquidation historically, and see how it works. And that's one of the cool things about an open source protocol is that you can analyze all of this on an address level basis.
And on average, this is probably a crazy question, but on average, what's like the over collateralization? 20 to 40%?
Yeah, exactly. Like on average, it's like 30 to 40%.
So another one from investors, can you please compare Compound to Aave?
Yeah, they're similar in that they're both protocols that allow you to borrow an asset using other cryptos collateral. Compound launched this model in 2018, and they were able to sort of reproduce a very similar system afterwards.
Some folks are kind of asking about maybe plans for scaling out across other ecosystems, Solana or Avalanche, or across kind of layer twos on Ethereum. Maybe just talk through folks where you're at.
Yeah, there's a few pieces here. So the Compound community is able to launch Compound on other blockchains. I think for the time being, the focus has been on Ethereum, but that's open to the community to change at any time. And there's a development effort to bridge external blockchains to Ethereum to introduce new markets to the Compound protocol called Gateway, which is a project that is in development to scale Compound beyond Ethereum assets to create a single interest rate market with a variety of different blockchain assets.
So we have does Grayscale have a compounded product? Yes, we do. It's part of our Grayscale DeFi fund, which is diversified fund that gives access to various governance tokens in the DeFi space. If you want to learn more, please reach out to us or send an email to info@grayscale.com. Can you talk a little bit more about the decentralization of Compound, the ways in which it's decentralized, and really paint that picture for everybody?
Yeah, absolutely. So Compound is a smart contract running on a blockchain. There's very few powers that are available to anybody to modify this smart contract. Originally, the power to upgrade or modify or change the parameters of the protocol was held by Compound Labs, which originally built Compound. This power was handed off to the community by replacing a single administrator of the contracts with the Compound governance system. So this is where the Comp token comes in. But the protocol is operating in a structure by which the Comp token is governing the protocol. It takes the powers that were held by a company and replaced them with the comp token. And so it's a smart contract system that has, a few upgradable parameters and systems, and the comp token has complete and 100% control over the protocol and all changes. There's no rights or abilities that our team holds anymore that are special or different from comp token holders. And all power to make changes is done in the open through an open governance process.
Yeah, Rob, and I think, maybe taking that and extending it to another question we're seeing in the chat, folks are kind of asking about, like how differences maybe between this DeFi approach that you guys take, which is open and transparent and global, versus like, some challenger banks or the fintechs, right? Maybe talk people through the real innovation here. Are you seeing those guys plugging into your process, and how do you think that plays out in the future?
Yeah, that's a great question. I mean, fundamentally, it's a very different type of model. So, one is you have a business that's operating, using people and like their own technologies. And, in order to get the product, you have to go to that company. And, it's run by a very clear organization. In a decentralized application like Compound, it's a computer program deployed to a blockchain that's open and running on its own, and that's not controlled by any one party, where you can have more assurances that the system is going to, do what it says it does than a closed or centralized product. I would say it's remarkably different and better, simply because you can have more assurances that a protocol like Compound will be around in 10 years, assuming that all changes to it are done safely and correctly.
Yes. Speaking of how you think it'll be around in 10 years, I mean, maybe talk us through kind of what you're seeing in terms of the user base that you've seen maybe in the past, and how you think it's evolving. Obviously, there's a few different segments between institutionalization and also enabling kind of, broader unbanked access. But I'd love to hear your thoughts.
Absolutely. Well, what's so remarkable is that DeFi itself is only a couple years old, and like Compound was one of the very first protocols to even create the concept of it. And we've seen the user base evolving over time as a function. A lot of it's anecdotal because there's not like, deep detail on all of the addresses interacting with Compound, and they're all just addresses at the end of the day. But anecdotally, it's really, been evolving from early adopting individuals interacting with a protocol like Compound to today, we're starting to see more and more businesses and professional trading firms and institutions starting to interact with the protocol, either building on top of it or using the protocol directly. And so, this is, I think, just one of the things that happens when a technology begins to mature. And, I think over time, what we're going to see is that the majority of the usage of Compound in 5 years is going to be coming from exchanges and custodians and institutions that are integrating Compound into their own products in some way.
Yeah, or maybe even banks, right? Are you having any conversations with kind of the legacy, bigger financial infrastructure players? What are you hearing?
Yeah, I mean, we're seeing a lot of curiosity. I think a lot of banks are looking to educate themselves on what's possible and how DeFi, changes markets for them. And so there's definitely a lot of curiosity, and I'm definitely, privileged to have had a few nice conversations, but I think it's too early to say or expect, anything specific from those types of institutions.
Yeah, someone else here is kind of asking about, they phrase it with it's a tough question here, and they're asking about kind of ETH gas fees. Do you have any kind of thoughts on kind of where that kind of puts the Compound product in the market? Obviously, we talked a little bit earlier about some of your other plans for scaling, but out to other chains. I mean, it's really up to the community, but I just wanted to hear kind of, what you think about the situation there.
In terms of the gas fees? I mean,
so how it's impacting the pricing and the product.
Well, it impacts every single application on the blockchain right now in a bad way. It's making it where it's not economic for individual users, especially with smaller balances, to interact with Compound. If it costs $50 to interact with Compound and you're only going to earn $50 of interest in a year, there's no reason to use Compound. So what we're seeing is, aggregation becoming a concept. So, and this goes to like will a bank one day use Compound, or will an exchange use Compound? I think what we're going to see is we're going to see more and more businesses that interact with Compound on behalf of dozens or hundreds or thousands or millions of users, where there's a single transaction that provides, access for a huge number of participants. And this is a very simple and natural scaling technique that we've seen, where you might have one address with a lot of money in it, but it's just representing 10,000 users. And I think that's the most obvious scaling solution that's occurring. And that is one that actually incentivizes institutions to be able to, create their own access points, because, $50 of gas fees for an individual is horrible. $50 in gas fees for 10,000 users is negligible.
Yeah, I think that's kind of the beauty of it, right? This open protocol, the way it gets used can just evolve on its own as the market evolves, right? And people can come in and create new innovative business models on top of it without any permission. Actually, it's a lot like kind of how a lot of payment transactions are even settled today with, batching instead of pushing them to the Fed. So
exactly, yeah.
We're seeing some questions pop up about the Treasury and the Treasury allocation. Do you want to speak to that a little bit?
Yeah, so there's about like 3.5 million comp tokens that are run by the community. So, the current comp token holders can decide, where and how comp gets distributed, how it gets used. And there's, a lot of comp tokens currently, directed by the comp token holders out there. This goes back to governance, which is, any comp token holder with a good idea or a use case for the Treasury can allocate it as they, see fit, if they can convince the majority of comp token holders to support their approach. But this is something that, is entirely in the hands of comp token holders.
Rob, could you maybe talk us through a bit more about like the issuance of comp and like kind of the, the supply curve? A lot of people think about the fixed supply of Bitcoin or the previously, infinite supply of Ethereum getting burned out. Talk to folks through how that works out a little more.
Yeah, absolutely. So there's 10 million comp tokens, period. There can't be more or less. And, there's a fixed number of tokens. At this point, there's, about 3.5 million tokens that are held by the protocol that comp token holders vote on how they get distributed to users. As it currently stands, and we can actually, I'll screen share this. We can go, as it currently stands, there's about 3.4 million comp remaining to be distributed. And the protocol is distributing 2,312 tokens to users per day. So it's like about 3 to 4 years of 4 years of remaining distribution.
That's pretty amazing. Again, we can all just kind of hop on here, participate, and then have some say in how this thing operates, right?
Exactly. Exactly. And if the token holders through the governance process want to change this, it's extremely easy to change, and it's one of the powers of decentralized governance.
Yeah, it's incredibly powerful. Someone's asking, does the app have insurance, right? Obviously, this is not like FDIC insured, like, obviously a bank, but crypto has kind of developed some of its own interesting insurance kind of ways, like, next mutual for some products. I mean, do you have anything like that on this, or is it kind of really just risk managed?
Yeah, absolutely. So there's no, conventional insurance products for something like Compound yet. I think DeFi is so new. If you ask that question in like 5 years, the answer is going to be of course. But this is a novel system that, doesn't have insurance yet.
I'm just seeing what else here makes sense to ask. Or if you have anything, you can mention it. I'm just looking through some more of the questions.
Yeah, so someone was asking about Solana, impact of Solana. Let me find the question. Of course, the second I need it, I can't access it. You know what? Let's come back to that one. What are Oh, here we go. How do you think Solana will change your approach and will you eventually support and compete against Sol Farm, Radium, and its higher throughput and scalability?
Yeah, it's up to the community if they want to deploy Compound to Solana.
Hey, Rob, do you have any sense like how, like how much of the lending market, you guys might actually capture? Or obviously we kind of know what the on-chain DeFi segment of it is. Do you have any sense about the kind of CeFi segment and kind of the sizing of these relative markets?
Yeah, it's a good question. I don't have as good of sense of the sizing of the CeFi markets because like they're the opposite of DeFi. They're opaque and closed, and any information they share, you're taking them at their word. And they don't really share much information to begin with. I think Genesis is the only one that's like sharing information. I think they talk about loan originations and things, but I don't have a good sense of like their outstanding amounts. But I think they're about the same size. I think, centralized players like, BlockFi are in the same zone of size. I think, in aggregate, I'd say the market is probably, close to 100 billion at this point, of which Compound is about 20. So it's probably about a fifth of the market.
Is that outstanding loans or is that originations over a time period?
That's outstanding. Yeah, originations is the worst metric possible because like
You can turn over so much.
yeah, like there's traders that borrow $100 million, repay it the next day, then borrow $100 million and then repay it, right? So I think originations is like really poor metrics. A lot of this stuff has very short turnover. It's just looking at what's outstanding.
Yeah, totally. I mean, honestly, if I used to work on like securitizations for like Lending Club and Prosper and SoFi, and when I saw DeFi and kind of what you guys are doing, but this is just the next iteration of this, right? And these markets have grown so fast. I mean, catching up to even those, right? And what's happening there. I mean,
oh yeah,
the disruption you guys you're having already on fintech, it's incredible. Just because anyone can plug into it, right? And I think that's why, given your model is just open, right? Anyone can just plug into this liquidity system, and it just creates this incentive for anyone who wants best pricing to really go to this system and check that first, right? Can I get that?
Exactly. That's why open is better than closed.
Yeah, totally.
It sounds like some people just want to hear your thoughts on DeFi more broadly and the bull case for DeFi. Again, looking more like a few years out.
Yeah, I think the bull case for DeFi is hopefully extremely obvious at this point. You have open, transparent systems that can run these markets with essentially zero overhead, versus systems that are run by people with spreadsheets that make mistakes or that commit fraud. DeFi is just a superior approach to creating financial products and markets. And I think, in 10 years, the majority of financial activity is going to be DeFi, just because it offers, when done correctly, a safer and, more fair and more transparent system. And it's something that users want. It's something that, the ones creating these markets want. It's something that, markets crave efficiency. And it's just a more efficient, transparent approach to markets than the legacy counterparts.
Rob, outside of your lending kind of segment you're focused on, is there any other maybe DeFi projects that you're more excited about than others? Could be across any of them, chains, any other segments.
Yeah, well, I think there's really three, primary use cases in DeFi right now that like generally dominate. So there's markets like Compound, which I think are easy to understand. Then there's decentralized exchanges. I think decentralized exchanges are in some ways another like holy grail of DeFi, in that when done correctly, they can be far superior to traditional exchanges in that they're faster, cheaper, better, lower slippage, all of these things. So I'm excited about a lot of different projects in decentralized exchange. And then lastly, there's decentralized currencies. And this includes things like Bitcoin, but it also includes things that are built in DeFi, like stablecoins, like the stablecoin DAI by MakerDAO. I think, get, lost in the excitement of newer things, but I think are fundamentally incredibly exciting and important as DeFi applications. And so my like top three use cases are borrowing, trading, and, decentralized stablecoins. I think they're sort of the most important use cases. And like, I still am most interested in those 3 use cases. But I think over time, you're going to start to see decentralized insurance, decentralized, derivatives, all sorts of products that, people want to migrate from the old way of doing things to faster, cheaper, more transparent, safer, more fair DeFi.
One of the things maybe we didn't even touch on as much as I think we could here, right, is how, because your protocol is open, all the code is there, anyone can build on it. It's really just these API layers and this financial economy stack and the innovation that's being built on top of it. We don't even kind of know what's going to evolve next. And just like DAI plugs into you guys, and maybe people, if they want to liquidate, they can use Uniswap to do those transactions. Like, and how all of this kind of infrastructure is so modular and innovative, right, and allows for innovation.
Exactly. I can't tell you what's going to happen next. The really exciting thing is that anyone in the community or anyone out in the world with a great idea can build it and integrate Compound. And it's not up to me. It's not like a process where people have to get our permission. Anyone can build new use cases.
I think I want to squeeze in one more like mechanical question. This is around custody. Does one to get involved, do they have to transfer their tokens to Compound, or can it work through like a Coinbase or Gemini or any other kind of exchange, for instance, or wallet?
That's a great question. And this goes to one of the things I was saying earlier is that right now, if you want to use the protocol directly, the answer is yes. So if you want to earn an interest rate yourself, you can supply assets directly to the Compound protocol, which is a computer program that stores and holds the crypto and administers the market. You're interacting directly with the protocol. Over time, there's going to be more and more ways to get the benefits of Compound, but with somebody else managing that interaction for you. So I think eventually, you're going to have, just like, Gmail eliminated the need to run your own SMTP servers, you're going to have platforms that offer you the interest rates from Compound, but you keep your relationship with them instead of interacting directly with the protocol. So you could have your Bitcoin on, some exchange, and that exchange interacts with Compound underneath the hood, but you don't have to interact directly with the protocol.
So we have to unfortunately wrap, but thank you so much, Rob, for joining us today. I think we all learned a lot. And thank you everybody who dialed in. If you have questions that you did not get an answer to, again, you can reach out to us, info@grayscale.com, or if you want to learn more about, our product that has Compound, again, please, feel free to reach out to us. We're here to help. And I hope that everybody has a really great rest of their day.
Thanks, everybody.
Thanks, everyone.
Bye.